Hey guys, Cam for Investors Underground here. Welcome to Beginner's Trading Guide Lesson 3 of 8, where we're going to be discussing bullish chart setups. If you've landed on this video and you haven't seen the two previous ones, click this back button here and it'll take you to video 1 of the series. You really should get started there. As I mentioned, this is video 3 of the 8 beginners lessons, and I've kind of impressed myself with how much content we've got through already in this beginner series. We've already covered an introduction to trading stocks. We looked at level 2, volume, time and sales and charts, and we've got a ton more to get through in both the intermediate series and also the advanced series that we're going to be putting out throughout the rest of this year. I'm putting out new videos on a regular basis, so if you haven't subscribed to the Investors Underground YouTube channel, you can do so here by clicking this button. It's free, and it just means you're not going to miss any of the videos when I put them out. Alrighty, let's get into the action. So first we're going to dive into what the definition of bullish is and where the word came from. So to answer this, I had to kind of give it a bit of a Google. I'll give you a combination of what I found and what I thought myself. So I think in American culture, the bull is a strong symbol of strength. Its stature and dominance and the way that it charges forward really represents the players in the market who believe it's going to go up. A bullish sentiment means that a person is optimistic about the upward direction of the market. And a couple of thoughts that I had around why quote unquote bullish is bulls attack upwards, and they're also angered by the color red, which coincidentally is the color of stocks going down. So the bulls look to get long, and in the market, long doesn't have anything to do with the time or duration or length that you're in a stock for. Long just denotes which direction you're playing the stock in the market. So what long denotes is somebody who buys a stock anticipating an upward move. So to enter a position, you would buy, and to exit the position, you would sell. So what kind of stocks are we looking for, and which markets or exchanges do we like to trade on? So we basically call our long strategy NASDAQ textbook longs. And this just basically covers all the momentum kind of names that we trade on a regular basis. Although we say it's NASDAQ, it's actually NASDAQ and NYSE, or the former Amex stock exchanges. So we don't really apply this strategy to trading in the OTC market. And we've got a lot of experience trading OTCs, but in the last 3 to 4 years, the OTC market has really dried up and died in terms of opportunities. As we talked about in the previous couple of lessons, liquidity is super important when looking at stocks to be able to trade. We find that the NASDAQ and NYSE exchanges give us the best selection of liquid stocks and momentum plays. And as the patterns are forming, they're the most reliable ones that end up fulfilling what they had set out to intend. Out of thousands of stocks to choose from, we always get a list of, 5 to 10 stocks every day on the scans that we might be watching intraday to see if they set up right for us to be able to place a trade on them. And we focus on a few key setups on the long side when we look to trade these NASDAQ and NYSE stocks. Let's have a look at some of those setups now. So the first one we're going to take a bit of a look at is the ABCD chart setup. And you guys may have seen this one in video 1 of the series when we're introducing long setups. But we really love the ABCD chart because it's great for beginners in that there's a set risk. It's quite easy to identify. It's a high percentage play in that if it starts to set up, then it usually follows through, and you often get paid out a great multiple on your risk. So I don't want to spend too long going through this because we already went through the ABCD chart pattern in video 1 of this series, but people have told me they get a lot of value out of, seeing it drawn out. So I'm going to do that for you now. So probably the most frequent question I get is, hey Cam, how do you know when to buy a stock? And the honest answer to that is it's not actually that easy. And I'm going to go into scanning for stocks that have the right daily setups that are primed to make these moves intraday a little later in this video, and also in more detail later in the video series. But let's say we do find a stock that we believe is primed on the daily to make an upward move. How do we know when to get in and buy intraday? So let's say a stock has made a big morning move and you want to get into this stock because this is a decent sized move and it looks like there's a lot of volume in it. So you understand that there's going to be momentum players who are also looking at this. But on the way up, how do you know when to buy this thing? If you look to get into it here, you don't actually know where your risk is. And a lot of people say buy the breakout or short the breakdown, but that's not entirely accurate because we kind of view that as herd mentality. That's the kind of stuff that they say on CNBC, and we know that no one makes money trading that kind of stuff. So what we believe is there's a better way to get into a stock that is on the run and looks like it's got a ton of momentum in it. So we call this point on the chart A. And now we're looking for a pullback to buy, but we don't just want any kind of pullback because let's say it pulls back to here and we want to buy it here. Well, we still don't know exactly where our risk is. So what we're waiting for is for this thing to put in a bottom, a higher low, but we're not ready to buy it yet because it still really hasn't shown its true intention yet. Because this higher low here might also be seen as a lower high for other people. So when do we want to get involved in this stock? Well, what we want to see is it kind of do like this, and this is what we see the ABCD pattern as. So B is the subsequent low, and C is anywhere in this area here. And the goal of this chart is to have a set risk down towards B, and your first target is somewhere around that A area to see how it trades. And the reason we like this chart so much is because you've automatically got a maybe 2-to-1 risk reward on your money if your risk is down here below B. And it's kind of clear that your risk should be below B because if this chart started to do this, well, the pattern's broken. You can go and stop out here. But really the idea of this trade is for it to start perking up and you have a bit of a look at what happens around this A area. You may want to consider half profits here if it seems to be stalling. But really the idea of the ABCD trade is once it breaks through that previous high of day at A, it shows up on everyone's scanners. It shows up on, the FinViz top of day list with high volume, and all those breakout chasers buy into it and it causes a spike and you're selling into that spike. And then we call this area here D. And something that I often observe on these ABCD charts is that a stock that has a bunch of momentum and is strong can do these ABCD patterns all day. And you can see here, it'll pull back and do that action again and break out again. So in this one here, you can see the A, the B, the C, and the D is here. So that's the ABCD setup. It got a little messy at the end, but I think you guys understand this pattern pretty well by now. Let's have a look at a couple of examples. So right now you're looking at the example BIOC. And you can see there's a few trades in the early morning. Essentially, if you're an experienced trader, you can trade the volatility in the morning and look for a couple of quick scalps. We might get into that a little later in the advanced series. You can disregard those trades for now. But what we really want to look at in this chart is the ABCD pattern. So a little green arrow means a buy and a little red arrow means sell. And you can see this area here represents what I believe to be the A. The pullback is the B. Maybe this buy was a little optimistic from Nate in terms of it hadn't really put in an extra little curl up, but he obviously wanted to be in this stock because it had a bunch of volume in that first push and he felt like it could be a runner. Purchased a little more in this area around here. And you can see when it broke out the high of day, volume stepped in and it really went for a run to this area all the way up here. It's probably a 20% move in a matter of less than an hour, where Nate's, probably in at $1.85, $1.90 average and selling into, $2.30, $2.40. And if you remember how I said that sometimes these charts can ABCD all day, when you have a look at this, we've zoomed out a bit and now we're seeing a little more of these candles. The first trade was here, and then it looks like it was kind of topping out, so Nate's obviously locked in the rest of it. However, when it starts to curl up, Nate's bought it up here, and he sold it again, making an extra 40 or 50 cents a share for the second time. And Nate doesn't like bragging about profits, but I wanted to bring up this P&L so that you guys can see that when Nate makes trades, he puts his money where his mouth is. He really believes in the strategy and he's scaled it so that the stakes are higher when he's trading. And you can see on this day, the trades on BIOC netted just under $5,000. And across the whole day, he traded a few other tickers, and this was a $20,000 day for Nate. So we're going to have a quick look at this chart EYES. And again, you can see there were a few morning trades. Nate obviously made money on them, but we don't expect you to understand exactly why or how they took place. We'll get onto those, I guess, in a later chapter in the intermediate or advanced series. But what we really want to focus on is the ABCD pattern again. And there are actually two ABCD patterns on this chart. The first one is here where this represents A, B is here at the subsequent low, C is here where the buys are, but this one didn't quite have the stamina to break out on this first attempt, and you can see it puts in a little lower high and obviously scares Nate off a little. So he sold it into there, but when it does perk again, we almost look at this as a bigger ABCD chart where A becomes this here, B becomes this area here, and C becomes this area where it's perking up a little. You can see the volume step in, it breaks out at the high of days. Nate's topped up a little more on the buys and sold it into the big volume pushes as the rest of the crowd comes in and starts to buy. Now you can see clearly that every group of trades were winners. Even the one that didn't manage to break the high of day was still a winning trade that Nate probably got paid out 1 or 1.2 to 1 on his risk on, so it still had a slightly positively geared reward to risk ratio. However, the main trade where most of the money was made was this one where we got quite a nice move to the upside. Again, a real nice payout on the risk at hand. And here's another $20,000 day where on this particular ticker, EYES, Nate netted around $8,700. Pretty impressive for a day's work. Well, I'm glad we're through that ABCD chart setup. I think everyone's got a pretty good understanding of the way that works and the mechanics behind it. If you like what you're hearing so far, please give me a thumbs up. It really helps out with the videos. And if you haven't already done it, you can subscribe to the YouTube channel. There are buttons on the page to be able to do it, and it just means you won't miss out on the videos that we put out regularly. So in this next section, I'm going to cover the gear and perk and also the bottom feeder setup. And basically the reason I put these two together is because all of these long setups kind of have similarities between each other. And in terms of the gear and perk, the way that I look at things is it's kind of like, a jack in the box where you wind it up slowly and then it pops and it comes back in, you wind it up slowly and it pops again. And these kind of stocks usually do this kind of wind up and pop on a repeat basis until the trend is kind of broken. And you can also see a little bit of an ABCD kind of pattern in this. It's not quite as structured as the ABCD, but as I said, all these longs kind of have elements where they're similar in a lot of ways. So I'm going to bring together two concepts here and introduce the bottom feeder style long setup. Basically a stock that's beat down really bad, puts in a higher low, and as it gains a little support, other people look to get in, shorts look to cover up, and it makes it pop a little and have a bit of a recovery. So this chart here is a great example. It's beat down from $28 to $19 in a morning, puts in a higher low here, starts to grind upwards. And you can see through these areas here, it's starting to tighten up, bit of a breakout, then another tightening up and a bit of a pop. So the next setup we're going to look at is the Washout Long. And we're just going to have a brief look at this because this is more of an intermediate or advanced chart setup. And essentially what this is the opposite of a parabolic short. We're looking for a stock that's pretty beat and has an accelerated move to the downside. And that acceleration is the most important part of this Washout Long. You want to look for price action that is almost unnatural. It's almost so crazy that you can tell there are a lot of people panicking. There's a lot of emotional traders, and you scoop shares into that panic, preempting a bounce. It's a very risky trade, but as you get better at reading points of inflection, you can nail a quick trade on this, a little scalp, and often make great dollars, even though your risk is a little undefined. So the way this might look on a chart would be a stock that is in a bit of a downtrend, but it isn't really doing anything that interesting. And then it kind of starts to speed up in that downtrend, and you see it moving a bit faster, and you get a big washout. You might look to scoop some shares through here, anticipating a bounce and selling into it to lock in profits. This might go against a lot of the common things that you're taught when you're beginning or starting out as a trader. Never catch a falling knife is a kind of common thing that you might hear all the time. And I don't entirely disagree with this for new traders. However, if you do want to trade one of these washout longs, it's really about your level of experience. So the question is, well, should you try and catch it? And that really depends on whether you're confident that you can make money in the flip or scalping out of it, and whether you can stick to a kind of dollar amount stop loss for a trade or for the whole day. You know, there are people who juggle chainsaws. It isn't something that I would do because I'm not good at it, but just because I'm not good at it doesn't mean that other people shouldn't do it if they've got a lot of experience in it and they think they can make money doing it. So as a day trader, not only do I find it very hard to buy and hold stocks, I also find it very foolish. And maybe I'm a little jaded or I've seen too much crap in the markets. But I think a lot of beginner traders really need to understand that if they're holding something or averaging down for the wrong reasons, that they can get stretch it out and decimate an account. And I wanted to use this NEWL as an example. You can see this stock is trading at around about 0.5 cents, but it didn't always used to be like this. And if you have a look here, this isn't an error in the chart. I'm going to scroll out a little more so that you can see. Essentially, every time you see this happen here, where it goes from here up to here, the company's done something called a reverse split. So let's say a stock's trading at 10 cents and they want it to be back over $1. They'll times the share price by 10 and give you 10 times less shares. So if you're holding this stock at 10 cents and you have 100 shares, the next day it opens up, it'll open up in $1, but you only have 10 shares. And the reason they do this is to continuously sell it down. So you can see they did it again here. It had a little bit of perk and they sold it back down until it was 50 cents. They did it again here. It would have been a 10-for-1 reverse split. Sold it all the way down to 5 cents. I guess did another split and it ran a little, but it came all the way back down and the same thing again. So if you are holding $100,000 worth of stock here, although it's trading at the same price over here, you would have been through so many splits that you'd probably have around $1.70 worth of stock. And while I laugh, it is kind of sad for people who don't understand that not everything has to go up all the time. And I think newer traders get stuck in longs that they really shouldn't be in, and then they justify holding it by saying, oh, well, it'll go back up. Things don't need to go back up. So I really don't believe in buy and hold, and I don't recommend it for traders who want to be in a day trading or a short-term swing trading strategy. So the next 3 pointers on here are kind of in-depth theories. What kind of daily charts are we looking for to be able to look for these longs, where the daily chart is really primed to help with these intraday moves that we're looking for, which also leads into multiple time frames, you know, looking at a 1-minute candle, maybe a 5-minute candle, the daily chart, and trying to get a big picture of whether or not this breakout is going to be a forceful one. Because the more time frames you line it up on, the more eyes are going to be on the stock. There'll be swing traders looking to trade it. There will be day traders looking to trade it. And also scanning for stocks. How do we go about finding the stocks that we want to trade? And I think it would be prudent to set up each of these topics as its own lesson coming up in the beginner series. And I know you've been hearing a lot from me, so I'm going to have Nate go into some of these together so that you can also get his take on some of these things. So the next point is stopping out. How do you know when you're wrong? So there's a lot of rhetoric out there that suggests that you should cut losses quickly. I think that doesn't really tell a full story about the best ways to stop out. It's my opinion that on every single chart, there's a point where the chart lets you know that the idea isn't working and that you were totally wrong in your thesis about the move and you should be out. And that's usually where I set my kind of mental stops. That's where I always calculate my risk based upon. And I'll give you an example here. So let's say we're looking at an ABCD pattern. We've got that morning move, the pullback, and then it starts to do this. I see some newer traders come into this trade, buying this here and setting their stops a penny or two below, thinking that's the way to trade this. So I guess what I was saying is, if this stock comes here and you stop out, is this chart really broken? Has it told you that you're wrong in your long thesis? And I don't believe it's told you that you're wrong yet. So I wouldn't stop out there. So cutting your losses quickly isn't entirely true because you've got to give this trade a chance to work. So while it might be tempting to try and risk 2 or 3 cents here and take it for $1 to the upside, it's not realistic. You're going to stop out more often than not. So if I'm looking to risk on this trade, I'd say, where is this thing broken? And I think if it did something like this, started making a lower high and snapped below this point, well, I'd say, hey, there's a pretty bad chance that this is going for a high of day breakout, and I'd be taking it off somewhere around here. Now, this is different for every kind of chart. So if you've got a washout long and it's kind of consolidating here and it perks up, well, how do you know that you're wrong in this trade if you've entered it in this section here? Well, if it doesn't have any follow through and starts to do this, you might say that you're wrong here when it hits the low of day and take it off as it's testing it or as it breaks through. So this is a scenario where setting the stop quite tight makes sense because the chart is broken a lot earlier. So whenever I'm risking on a stock, I ask myself the question, when does the setup not make sense anymore? When does it not work? And I'll base my risk upon that, watch it trade out, and if it doesn't look like my plan is working, I'm happy to take it off, even before my stop area hits sometimes. Let the chart speak to you. Try and imagine you're not in the trade and let it tell you which way it's going. Now, for a newer trader, hard stops are probably the way to go because you may not have the discipline to stop out here manually and you might take it for a ride down to the next level. But for a more experienced trader, I like to be a little more fluid in my decision making. I like to let the chart unfold and see if it's trading in a way that I like, even if it does kind of pop through my stop for a moment. So as you gather experience in the market, you're going to be able to make decisions based on stops much better and letting the trades work out for you rather than getting chopped around and killed by commissions. Wow, so we really got through a ton of stuff. If things don't make 100% sense right now, that's okay, it's fine, it's actually even normal. You can't expect to learn how to day trade in a few 30-minute lessons. You know, Nate and I have spent years learning how to trade, and we actually collectively spent 1 year together on each of the DVDs, both Textbook Trading and Tandem Trader, to ensure that all the right content was in there for people to learn from. Between the courses, there are 20 hours of lessons just like this, but in much more detail and with some live trading action as well, and many more examples, so it all makes a lot more sense. And you can fast track your learning instead of waiting for me to put out videos every couple of weeks. So speaking about putting out videos, the next lesson we're going to be doing is going to be about bearish patterns. So we're going to be talking about the short setups that we like to look for when we're trading stocks intraday. If you haven't subscribed to the YouTube channel already, you know you probably should. So go ahead and click a button. It's as easy as that. And if you've got any questions or want to chat at all about your trading, you can drop me an email. I'm cam@investorsunderground.com. I read them all and I'll get back to you personally. This has been Cam for Investors Underground. Good luck with your trading.